Hey traders, this is Blake Morrow with Trader Summit, and I have Mr. Jim Welsh with us today. It's Friday. Good to see you, Jim, and happy debt ceiling default weekend. Oh, is it Memorial Day
Well,
weekend? I'm sorry.
I was going to say, more importantly, Memorial Day weekend. Hope everyone has a safe weekend as we remember a lot of folks who made the quality of life that we have possible.
That's right. That's right. Now, yeah, you get a constant reminder of where you live, being in Southern California with all the military bases nearby. So I'm
Yeah,
sure you have a constant reminder of the Memorial Day weekend. And
absolutely.
yes, happy Memorial Day to those that are celebrating, and definitely to those who have given the ultimate price for our freedom. So thank you.
Yeah, yeah.
Um, so Jim, we're in the midst of debt ceiling debate right now between the president and the House and the Senate. And do you think a deal is going to get done? And what's your timeline look like? Should we just ignore it all? I mean, what are your thoughts here?
Well, in terms of timeline, let me get a quarter out and I'll flip it. And heads it sooner, tails it later. No, I think I'm like the majority of people where you realize or believe that one way or the other they will get a deal done. It's just a question of, do we have to put one foot in the abyss or not before that happens? But I, right or wrong, I fully expect that they'll come up with a deal because the consequences are too dire, really for either party to, escape the blowback that would come from it. So it's just a question of when they get it, and the deal has to be a deal where both sides will be able to sell it to their constituencies. Hey, we held out and we got this, and so forth. So yeah, I think one's going to happen, and I think the majority of markets have been trading as if they, the majority opinion is that, hey, they're going to get a deal done.
Yeah, now that's the way the market's trading right now. We're less than a week away from the quote unquote X date, at least the date that Janet Yellen set forth, which may or may not mean anything, but more
Right.
importantly is the market's probably going to get a little bit more nervous as we approach the first
Yeah,
of
the
next
11th
week.
hour. The
Right,
11th hour and 59th minute.
right. Well, the question is, are since it's such polarizing politics in the United States right now, and probably in your lifetime more so than you can remember.
Yeah.
You know, are we going to be pushed to the brink where the market actually has a bit of a heart attack before you know
Yeah.
our
That's
U.S. leadership comes to a decision on this debt ceiling?
that is that's the possibility. I mean, I'd like to think my view is similar to a lot of people where you look at both political parties and I can't help but feel like, is this the best that we have? Really? But it is what it is. So, to the point that, there is a level of uncertainty. And I think there's a fair amount of hedging that has taken place going into this to address that uncertainty, which means that once the deal is done, those hedges will come off. Plus, the S&P getting above 4,200, staying above 4,200, technically, a lot of people are going to say, hey, we got a breakout, and yet, is it true? Absolutely, because that's been a real ceiling. I think fundamentalists will look at it and say, hey, the S&P is telling me now that it's above 4,200 that we don't have to worry about a recession. So my view has been, I believe we're going over 4,200. There's a shot at 4,300. The high last August was 43.25. But so you can get this spike with everything coming together. Zero dated options, adds a lot of octane to any intraday move. But I believe that once we're past the debt ceiling, the focus is going to shift back towards the economy. And my expectation, as we've talked really for quite a while, is the economy was going to be okay in the first half. It's the second half that I think we're going to see more signs of slowing. And I think that's going to be the hurdle that the market has to try to get over. My take is I think the slowing is going to be significant enough that we're going to see the market roll over and the S&P ultimately test the 3,500 low from last October.
Well, let's go ahead and just we're going to take a look at your charts that you brought. I think the first one probably will help illustrate exactly what you're talking about, Jim. And let's get to it. Go ahead.
Yeah, this is the New York Fed has a recession model. And historically, you can kind of see that it ticks higher prior to recession. The shaded pink lines, if you will, are the beginning and end of recessions. Historically, when it's gotten over 30%, Blake, we've had a recession that's followed. It's at 68%. And this is like a recession occurring in the next 12 months. So it's not like saying next week. And again, as we talked last week, the excess savings that a lot of consumers accumulated during the pandemic is slowly but surely being worked off, spent off. I think by the end of this year, most of it will be gone. And that has been one of the driving forces to keep consumer spending healthy, along with a number of other things. So I just think it's a question of when we see a rundown in that excess savings pool, that's when we're going to see a greater retrenchment by consumers. I think it's going to happen progressively in the second half of this year. So this isn't the only indicator that we've talked about. The leading economic index has been down 13 months in a row, has reached a recessionary level that's been preceded by or followed by a recession since 1960. So these very reliable indicators are all singing the same song. I just think they're pushing up against this pool savings. Unemployment rate really, 54-year low is just going to take a little bit more time. And the net result is because a lot of people thought there was a recession last summer, then would happen by the end of last year. And now, gosh, if it hasn't happened by now, we're not going to get one. So to me, it's just, people were premature and wrong, and they've kind of tossed in the towel. So my take is I believe we're going to see the slowing really pick up as we get past mid-year. And, things like this New York Fed model in terms of recession indicator is one of those things that I think is, hey, if you look back, it's been pretty darn reliable. It's not a question of if a recession takes place when you get this much of a signal, but when. And lending standards, which we've talked about really since February, I think at least, really is a big deal, because now you're not only have the price of credit been increased by the Federal Reserve, now banks are reducing the availability of credit. Well, that, if you're a businessman and if your business is decent shape, you may not be happy, but you can afford to pay a little bit more for a loan. Sure. But if you can't get the loan, or you're only going to get 80% of what you think you need, that's an entirely different economic outcome. And that's what I think is going to really be the drag between now and year end.
All right. Well, the next chart you brought is regarding core inflation. We had the PCE data come in today, and it came in a little hotter than, wait, hold on. Let me make sure I got my numbers correct. But it came out today, and
it's 0.4 versus 0.3 expected, I think.
Yeah. So it came, now not the core, but it did come in a little bit higher on the, I'm sorry, that was the core PCE came in a little stronger than expected.
Right.
And so what do you make of this inflation picture, and how's that going to factor into the economy?
Well, I think, what this table shows is a lot of different inflation measurements, all sliced and diced differently. But when the Fed looks at this, and again, you can see we're going to get more data over the next few weeks. But if you look at this, you can see on a number of them, inflation didn't go down from April of last year through April of this year. It actually ticked higher. So some of this is due to the way shelter is calculated. Certainly in the CPI and the PCE. And as we all know, housing prices have been falling. Rents have come down pretty significantly, although they've ticked up a little bit in the last month or two. The point being is that price in the real world that has taken place in the last year is going to start to bleed through into a lot of different inflation metrics. But if I'm a Fed member, and I think we've heard that pretty consistently, is frustration that inflation hasn't come down more. And this underscores, if you will, that argument. So this is why I think we're seeing a lot of tough talk by a lot of the FOMC members. And at the same time, I think there's this intention to push back against Wall Street expecting 2 rate cuts before the end of this year. I think the Fed, it's incredulous that the Wall Street would think that. And we've seen it. I think it was like maybe 6 weeks ago, it was 2.5 cuts, right after the regional banking thing. And now it's maybe 1.5 cuts. So slowly but surely, the combination of the data coming in not as favorable and the messaging by the Fed is causing people to like, okay. Plus, economic data, as I noted last week, the Atlanta Fed GDP now for the second quarter ticked up to 2.9%. So again, we're seeing consumer spending being sustained by that pool savings and 50-year low in unemployment. And you add it all up, I think there's a good chance that the Fed won't raise the funds rate at the June meeting. But as Chris Waller, who's the Fed governor, said, is it going to be a pause and a skip? Potentially. And I think it's really going to come down to, Blake, where some of these other inflation metrics, by the time they have the July meeting, if they aren't showing more progress, then I think the Fed will be inclined to raise rates then. In the near term, again, the tightening of bank lending standards, how much they're being tightened, the impact that's going to have on the economy, plus the cumulative impact of all the rate increases over the last 14 months, I still think the Fed is going to be a close vote. I think they're going to not raise at the June meeting and buy that extra 6 weeks of time. But this is one of the reasons why the idea of the Fed cutting rates in the second half of this year, has just been ludicrous. And I think now Wall Street is starting to get that message.
All right. Well, now they're getting that message, but it hasn't really mattered to the markets so much because the stock market continues to grind higher. I mean, we are at 4,200 on the S&P. The NASDAQ is just flying. And the next chart that you brought is the S&P weighted and NASDAQ weighted charts, right?
Equal weighted. And what these are, if you think about the S&P, 500 stocks. So if every stock had the same weighting as Apple and Microsoft, it would be 0.2%. Apple and Microsoft is like almost 15%. So when those stocks are doing really well, they can cover the underperformance of a lot of other stocks. And what we can see is since the beginning of this year, on the equal weight, it's flipped. So it's gone from being 3% better than the S&P to 7% below. That's an enormous shift and relative weakness. The same things with the NASDAQ 100, which is, as you just noted, is making big moves. The 618 retracement from the high of November in 2021 on the NASDAQ or the QQQs to the low in October is 349. So my take in this last week's weekly technical review is if the Qs get above 347, it's time to put a 25% short position on with the S&P 500 because I just believe that ultimately what's been going on here is the lack of selling pressure. Why? Because people are convinced the economy may be avoiding a recession. So the lack of weakness in the economy is helping the market hold up better, and the narrowing in focus in these big name heavy weighted stocks in the NASDAQ and the S&P are causing them to keep pushing higher, even though the rest of the market is lagging badly. Historically, that is not a healthy sign. But as I've said for probably weeks and weeks, until a reason to sell shows up, it can continue. And I believe a reason after mid-year is going to show up. The economy is going to slow more than expected. But in the near term, my take was we're going to get a debt ceiling. The S&P is going over 4,200, might get up towards 4,300 on the NASDAQ 100, and the Qs talking around 349 and change. So
Jim, I got a question for you. This actually came in. Somebody asked me on Twitter, me personally, and I thought this would be a great question for you since we're happen to be looking at these charts. If we do go into a recessionary period as you expect into the second half of the year, are these stocks that have outperformed the Microsofts, the Apples of the world? Do you think they're going to outperform to the downside, or do you think that they're going to be that undercurrent that keeps the markets from selling off too aggressively? Let's just put it that way.
Well, first of all, let's say they just revert and they start to perform as badly as the overall market does.
Yeah,
you will have removed a huge prop under the market. in a sense, think of the market. When the market is strong and healthy and everything's running, it's like a pyramid, right? Well, what we've done now is flip the pyramid upside down. So the cone is what's holding it. That cone is a small number of stocks. When that small number starts to underperform relative to what they've been doing, the rest of the market isn't likely to pick up the slack. So to answer your question is these stocks just perform like the rest of the market? Think of where the S&P would be and the NASDAQ would be when you look at these two charts.
Sure.
The averages would be quite a bit lower. Now, potentially what happens typically is initially they hold up okay. And then at some point in time, the great gains that people have in these stocks start to get taken away. And all of a sudden it's like, maybe I better lighten up a little bit before they take it all away. And that's kind of what typically happens near at least an intermediate trading low, where the strongest stocks finally give up the ghost. So it's a process. It's not going to happen overnight. But, what I saw in 2000, a lot of people said, well, these tech stocks, they don't need to borrow money because rates have gone up. They can just issue stock. They're okay. But if you look at industrial stocks, the basic material, the nuts and bolts of the economy, if their business is going weakening, what do they do with capital spending? Well, guess what? That does have an impact on technology stocks. So all of a sudden, the big sales growth and all the so really starts to decelerate because the economic slowdown starts to really take a toll. Yeah. But it doesn't happen overnight. It takes, months and months typically. But that would be my guess, is ultimately these stocks are going to weaken to the level of the overall market. And then I think if we go into a real recession and a hard landing next year, then these stocks, because they're overowned, are going to, they're going to be a source of capital.
Yeah. Okay. All right. Great answer. Now the next chart you brought is of the S&P as a whole. You've expected a move higher, above 4,200. Still looking for 4,300.
Well, I'm not sure how high we're going to go above 4,200. I mean, again, with a debt deal, you can get a spike, short covering. A lot of things can happen. As you can see, the indicator MACD on the RSI got oversold at the lows this week. Last week, I said, hey, we had to hold 4,100. You can see we held 4,104 was the low. And so it was set up to get a slingshot. 4,250 should be easy. The August of last year's high was 43.25. So, again, if we get a debt ceiling, you get a very big spike. Again, my take has been wait for this to happen and then look to be a seller as soon as the market looks like it's starting to roll over. So to me, north of 42.50, and as I said before, the Q is getting above 349. To me, those are price levels that I would say, all right, it's time to put something on in terms of a short position.
All right. So you're still looking for a short up there. Now, what does this all mean for the dollar? Because the dollar has had a nice rally. We're stalling right around the 618 retracement. There's a fib level right pretty close to where we're at. Have we peaked, or are we going to go higher?
I think short term, you can look at the bottom panels. The RSI got up near 70, so a little bit of a pullback makes sense. The euro is a bit oversold, so it's due a bounce. My premise was that technically you had kind of a double bottom just below 101. It could be a wave below. And the weakness that we saw after the wave A top in early March was, predicated on, the Fed may be actually cutting rates because of the regional bank crisis. Surely they'll be cutting them in the second half of this year. And as you know, my take was that isn't happening. And as people figure that out, it should be a tailwind for the dollar. The other point I made last week was the euro economy is softening, I think, more than people expected. That people were surprised, understandably, in the fourth quarter early this year. It's like, oh my God, the economy is going into the tank because of high net gas prices and everything else. Well, none of that came to pass, but we are starting to see more softening. Plus ECB, because the inflation numbers came in hotter than expected, is talking about hiking rates. Counterintuitive, but sometimes currency markets trade more on the projection for economic activity than they do for central bank policy. So my belief is, you're a little overbought short term, a little bit of a pullback. I still think the probabilities are high that the dollar is going above 105.88 over the next couple months or so, as people realize that the Fed is not cutting rates.
All right. Well, then that's the dollar. And how do you feel about the next chart that you brought up is the gold market? Because the gold market's gotten towards this 1935 level, which is kind of a little bit of a support down over here. We're at it right now, but you really have expected to move lower in gold. How much further can it go? I mean, gold bugs want to know.
Yeah, well, I think near term you can get a little bit of a bounce, because gold has dropped from 2004. It's dropped $100 in 3 weeks, give or take. Yeah. So to me, a bounce back towards the 1980 to 2000 level would make some sense. But I think after this bounce, there's another decline coming that will take gold closer down towards the 1920 level. That was also an area of some chart activity going back 6, 8, 9 months ago. The 382 retracement of the whole rally from last September's low to the high a few weeks ago is around 1890. So, but the bigger picture, again, my take is we've had wave one up of a rally that's going to take gold to a new all-time high. Now it's a question of we're going to get a wave two pullback. And once this wave two pullback is over, then I think gold is going to break out to new all-time highs. 2250, 2350, I think is what's going to happen before the end of this year. It's just in the near term, dollar strength, I think, is going to be too much of a headwind.
Yeah, okay, that makes sense. If the dollar does manage to strengthen from here.
Yeah.
The last chart you brought is obviously TLT. We've had this massive move in yields. It's been quite staggering to me watching the bond market come under such pressure and yields rally. Is that going to sustain?
Well, here's my take has been that we were going to see a pullback. I went long under 102.84, got stopped at 101.35. All right. TLT can get below 98.88, possibly. All right. The hurdles are you get a debt ceiling that removes some of the economic uncertainty. It also means that the Treasury is going to be issuing an awful lot of paper. And that supply is going to have to be absorbed by the bond market. And two things start to happen. Initially, the dealer community will short futures because they're going to take down the cash to hedge those positions. So that can weigh on Treasury bond future prices, which obviously weigh on the cash too. The key, it's kind of like a push-pull. How soon are we going to get more data that shows the economy is really slowing? Because that, to me, is what's going to be necessary for TLT to put a low in, then get above 110. My expectation is that is coming. Is just in the near term, it could get a little dicey between the debt ceiling and the supply surge that's going to follow the approval of the debt ceiling. But as you noted, yields have ticked up pretty nicely. And if you think that a recession may come, if you're an assurance company or an institution, 375 on the 10-year is not a terrible yield after, sub 1% for, what we saw for about 18 months. So I'm still bullish, but I'm waiting to see some of these other things happen. And obviously the trend has been working its way down, but it's finally gotten to a point where it's a little oversold. So I just think I'm just trying to be a little patient for these other factors to play out.
So Jim, let's say in a bold new world that we're in right now, the debt ceiling, they can't come to an agreement. We actually end up defaulting on a couple payments on a few different things. Maybe you can use your imagination.
Yeah.
What happens to the bond market in that situation?
I think ultimately the bond market rallies because the economic impact is going to be significant, coupled with the fact that things are already slowing down. So,
but initially, the knee-jerk reaction should be lower Let's say we get a couple of downgrades, which a couple of ratings agencies threw out that warning this week. Let's say we get some downgrades initially when the bond market get just hammered, and you're going to see yields scream higher.
There is that risk. I mean, again, from the pattern standpoint, probably a month ago we looked at the TLT pattern from 2020. It's like 1, 2, 3 down to the low that we saw in October of last year. So then it's like, okay, we're going to get a wave 4 rally. And that's why I thought TLT was going to rally. It's a question of, okay, TLT went from under 92 to over 109. So that is wave A of that wave 4 rally, or it's all of it. So now we're pulling back in what I believe is wave B to be followed by wave C of 4. And then yields go up significantly to higher highs. But there is a real risk, to your point, that might have been all of wave 4. And yields are just going to grind higher here for a lot of different reasons. That is a risk. That's why for me, it's like, okay, I'm waiting to see. I have, an outlook, but, the probabilities aren't 100% or even anything close to that, But ultimately, I think that any disruption from the debt ceiling is going to spill over into the real economy at a point in time where we're poised to slow down anyway. So, but it could be wrong. Maybe the economy doesn't slow all that much. Inflation continues to be sticky. All of a sudden the Fed is talking about not one more hike, but 2 or 3 more hikes.
Yeah. Which could be the case.
Which could be it's possible.
Skipping is like a stone.
It's possible. And again, ultimately, I think the pattern in the S&P calls for another decline down to the lows of October at 3,500. My assumption has been hey, we get in the second half, the economy is going to weaken enough to bring earnings expectations and forecasts down and blah and all the rest of that, right? But maybe it's just Fed has to do more, and then the decline will probably go beyond 3,500.
All right.
So the next few weeks are obviously kind of critical, but the odds are that one way or the other, if the markets start to misbehave, that'll put pressure on Washington to get their act together.
Sure. That's usually what has been happening. It's happened in the past. It can happen again.
Yeah. And it's interesting. When they came up with the debt deal in 2011, the decline that followed was after they had the debt deal. So, it's again, I think the economy holds the key, and it's until we start to really see things slow that Wall Street's going to be encouraged, because they still think earnings are going to go up 11% between now and year end. You're not going to be a seller if you think that's going to happen.
Yeah. Great point, Jim. All right, Jim. Well, it's been great having you here this week, especially in such a critical and crucial week. And even though it's a Memorial Day weekend, it's still a weekend that we're going to be paying attention to headlines. What's the best way for us to follow your work? And I love it that you actually update your readers of your newsletter. Sometimes ad hoc in between. If
it's necessary. I do a weekly technical review in addition to a monthly letter, macrotides.com. If you'd like to receive last week's weekly technical review, jimwelshmacro@gmail.com, and I'll send it to you.
Jim, I always appreciate our time. I hope you have a wonderful, long extended weekend. Hopefully you can relax a little bit.
You do the same.
And that goes for everybody out there too. And if you have any comments for Jim, make sure you jump down below. Jim, I saw you were addressing some comments that came in this last week.
Yeah.
So if you have any questions about anything that Jim has covered, subscribe to the channel, comment down below, and give him a big thumbs up for being here, and give a thumbs up for yourself. Have a wonderful, wonderful weekend. Thanks, Jim.
You got it, buddy. Take care.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.